Welcome to the Federal Retirement Podcast. My name is David Rates from Benchmark Financial Group, and every month we discuss important topics regarding the retirement planning process for federal employees. This Lunch and Learn series is an interactive discussion where individuals can ask questions. To join these discussions live, you may register by joining our email list at bfgkc.com. Additionally, if you're looking for assistance to get your retirement on the right track, set up an appointment with us today. You can schedule an appointment online by visiting our website at bfgkc.com or email me at david.rates@bfgkc.com. The contact information is also listed in the description. By setting up a complimentary consultation, we can review your financial situation and develop a plan to meet your financial goals. We hope you enjoy this topic and hope to connect with you soon.
Welcome to Benchmark's webinar. My name is Patty Riley. I assist David Rates, President of Benchmark Financial Group. Questions are welcome. Feel free to type them in the chat box or unmute and ask. Today, our topic is Countdown to Retirement, the 6-step playbook for federal employees. David?
Well, thanks for tuning into this month's call, everyone. Like Patty was saying a second ago, topic for the month is Countdown to Retirement, and we thought we'd highlight just a few important steps to get yourself ready for retirement. So feel free to chime in with any questions that come to mind. Alrighty, so looking at it from a macro view, some of the main points to have in the back of your mind. Obviously, you want to know your benefit or familiarize yourself with the cards that you're working with. So have an idea of how first pension works, think about what you want to do with TSP savings, figure out whether or not you're eligible for the first supplement and know what Social Security is going to pay you. And then take a look at your FEHB options and FEGLI options. Running the numbers is an important one in addition to that, because you want to get an idea of what those benefits are going to pay you relative to the net monthly income that you're used to living on while you're a full-time employee, and compare that to net monthly when you switch to being a retiree. Gathering documents, so we'll take a look at some of the important identifying information to get your hands on to prepare yourself as best as possible. Choosing a date is an important one. Whether or not you want to retire midway through the year, a lot of times the end of December or 12/31 is an important one, but that usually hinges on how much annual leave you have going into the home stretch of retirement. And then whether or not you're in a special retirement category where you might have an age-based mandatory retirement. So that'd be like air traffic control folks or law enforcement officers. If they force you out at a specific age 56 or 57, there's sometimes some extra planning that goes into place so you don't have any unpleasant surprises. And then managing your investments. Having an investment strategy to get to retirement, and then an income and investment strategy for the years after retirement. Because you got to take into consideration, if you're retiring at 60, for instance, the plan is to have you live several decades of a long and happy and healthy retirement. And then take a look at estate planning or any legal documents or beneficiaries. Sometimes people go down the road of setting up a will and a trust. So that's something to take into consideration as well. So moving on to step one, or know your benefits inside and out. So this one's just a little refresher on the difference between FERS and CERS. So CSRs folks are getting pretty rare these days. Most of the time, people who we're talking to that are nearing retirement are in the FERS retirement system. So that FERS retirees or FERS employees hired after January 1st of 87, three main pieces of the pie for retirement benefits are your FERS pension, that lifetime annuity payment, Social Security or FERS supplement or Social Security, and then TSP savings as well. And your pension calculation for a FERS is generally it's 1% times high 3 times years of service, or if you're at age 62 with 20 or more years, you get that 1.1 or that 10% higher calculation. Depending on how many years of service you have and the age that you're looking to retire, you might be eligible for the FERS supplement. And then it's important to remember too that FERS employees get the 5% TSP match. Over the years, a lot of people said that CSRS folks had the best retirement system, but if a CSR, now granted, you have a higher pension calculation with CSRS, but a lot of them weren't that diligent about saving money in TSP, especially if they didn't get that 5% match. So depending on how things shake out, sometimes the CSRS folks were kind of married to that higher pension payment, whereas the FERS folks had a little bit more flexibility with oftentimes higher TSP balances. So when you have a healthy TSP balance, it definitely gives you options going forward as a retiree. So some of the key benefits to keep in mind and review. CSRS or FERS pension, you want to get an idea of that projected monthly income so you don't have any unpleasant surprises. Make sure that your service computation dates are correct. Social Security, you want to get an idea of what that benefit is going to pay you at 62 at the very least, or at full retirement age, or 70, especially if you're looking at potentially having a spousal benefit, because keep in mind with Social Security, spouse is entitled to their benefit or 50% of yours. FEGLI life insurance is a big one. Oftentimes people are hanging on to federal employee group life insurance. They'll hang on to basic, and if they have option A, they'll keep that and take what's called a 75% reduction. It's just important to know how the pricing of federal employee group life insurance changes once you hit the point of being a retiree. In a nutshell, the cost goes up noticeably, but it's not all bad. It's just a matter of knowing how to set FEGLI so you don't have any unpleasant surprises with pricing. TSP, you want to get an idea of how the money's invested and think about an income strategy and an investment strategy, especially going back to that idea of the plan is after you retire from the federal government to live several decades of a long and happy and healthy retirement. So thinking about ways to generate growth out of that chunk to carry you forward through that long haul of retirement without taking an excessive level of risk. FEHB, you want to confirm the benefits. Think about spousal benefits, because it's important to remember that surviving spouse benefit on your FERS pension is kind of like directly intertwined with FEHB. You got to leave either the partial or the maximum survivor benefit for your spouse to continue forward with FEHB if they are the survivor, which is a big deal because the federal government pays about a little over 70% of the cost of that FEHB coverage through both of your lives. And then the FERS supplement, you want to get an idea of what that supplement's going to pay you and then how that payment's going to change once you get to age 62, because the supplement automatically stops at 62 because that's when you're eligible to start Social Security. That doesn't mean you have to start Social Security at 62. It just means that now that you're eligible, that supplemental payment automatically stops from OPM. All righty. So running the numbers or your retirement financial assessment. So just a refresher again, the three main pillars of retirement income, FERS or SERS pension. It's important to remember that's a lifetime income payment. So independent of market variability, Uncle Sam's going to continue to keep spitting out those pension payments. It's based off years of service and whatever your high three salary was at the end of your career with the federal government. High three salary is your highest 36 consecutive months too. Get an idea of the survivor benefit, whether or not you want to go with no survivor benefit, the maximum survivor benefit, or the partial survivor benefit, because you need to know what those amounts are going to pay and what the cost is to make an informed decision there. And then knowing that on the FERS pension and the CSRS pension, it goes up with the cost of living increase. So long-term average for FERS retirees is right around 2 or 3%. Sometimes it's higher, sometimes it's lower based off consumer price index, but it's good to know that it does have a cost of living increase, or your pension payment like 15 or 20 years from now is going to be noticeably higher than it was at the point that you retired. Social Security, when to turn it on. It's important to remember with Social Security, the name of the game is squeezing as much money out of the Social Security Administration as possible and living a long and happy and healthy retirement. So do you claim it at 62, or do you wait until full retirement age, which for a lot of folks is 67, or do you wait to max it out at age 70? Take a look at your spouse's benefits, whether or not they're entitled to theirs or 50% of yours. The spousal benefit was primarily designed for folks that didn't work. They had enough credits to get a Social Security benefit, but didn't spend the majority of their careers working outside the home. So if you have a spouse that, based off their working history, their benefit might be like $500 or $600, and your Social Security benefits like $2,000, for instance, then easy numbers, the spousal would be right around $1,000 a month, which is higher than $500 or $600 a month. So in a nutshell, that's kind of how the spouse benefit works. And then you also want to coordinate all of these benefits with all the other moving parts. Moving on to TSP, it's important to remember too that you have the ultimate flexibility with TSP because it has a cash balance tied to it. Your pension and Social Security are monthly income payments, but you can't easily get like a withdrawal of a couple $1,000 for something that happens to the house, for instance, or emergency opportunity withdrawal, like vacation or something like that. So it's important to remember the usefulness of TSP because of the fact that it does have that cash balance tied to it, and it's kind of like the main source of emergency or opportunity pool going forward. And oftentimes people look at rolling the TSP balance to an outside IRA because you have a lot more options in terms of how the money can be invested. When you can get funds that are invested in different indexes or different sectors, it can make a big difference in terms of the total gain that you can make going forward. So knowing your expenses before you retire is an important piece of the pie too. Now, fixed expenses, housing, oftentimes people want to rush to get their houses paid off before retirement, but as long as you have a low interest rate mortgage, that's kind of like a prime piece of property in today's environment. So if you're sitting on 3% mortgage, the name of the game there is, well, if could you strategically invest the chunk that you would use to pay the mortgage off and make more than 2 or 3%? That's something to think about. Health insurance premiums are always going to be a piece of the pie. I always say death taxes and slightly higher health insurance premiums are something, 3 things you can be assured of in life. Insurance policies, you want to take a look at those. If you have term policies, you want to know how far into the duration of the term you are, whether or not you have conversion options, or if you've got like old whole life policies that might have a lot of cash value in them. You want to take a look at that too, because oftentimes people get to the point where they're whittling away the things that they were using the insurance coverage for. You get debts paid off, your house is getting close to paid off, you've got cars paid off. Sometimes it makes sense to keep those in force or have them be a reduced paid up option. Or sometimes people, if they don't necessarily need the insurance, or if it's like a $50,000 policy that's got $20,000 or $25,000 of cash inside of it, sometimes they'll take the cash and then reinvest that into like a non-qualified brokerage account. Debt obligations, oftentimes people have chunks of debt that they want to pay off at the point of retirement. So there's nothing wrong with that. It's just something you take into consideration. When you're stacking up debt to pay off, you want to go with the highest interest debt first and go forward from there. Variable expenses, travel and leisure, entertainment and dining. A lot of times people will stack up they'll think about how many trips they want to take throughout the course of the year and plan withdrawals out of TSP money or IRA withdrawals accordingly, and then healthcare costs. Or checking and making sure that the plan that you have in FEHB is the plan that you want to have from one year to the next, and marking your calendar for open seasons if it makes sense to change. So moving on to step 3, or gathering your documents. So the 90 days out, that's generally when you want to submit your retirement paperwork to HR. In terms of familiarizing yourself with these benefits, that one you could start as soon as possible, because oftentimes when you're trying to absorb all this stuff, it feels like you're drinking from a fire hose. So it's not uncommon for it to take 2 or 3 times before it really starts to click. So some of the 8 kind of main pieces of info to keep an eye on: a recent leave and earnings statement. That one's always important because you want to take a look at what your net monthly income is, or flip it from biweekly to monthly, and then take into consideration the deductions that you pay for when you're working full time relative to the deductions that go away when you're a retiree. A recent retirement estimate from HR or GRB, those are always helpful. Or if you're having trouble tracking those down, just the annual FERS benefit statement that they update every year in January. That one provides a lot of useful information if it's difficult to get your hands on a retirement estimate. Just a recent TSP statement so you can get an idea of the balance, and just a refresher on how the money's invested. The important one there is knowing the difference between how the balance is invested and how your contributions are invested too, which we'll take a look at here in a second. Any other investments or like IRAs or old 401ks that you had earmarked for retirement income, life insurance policies, long-term care policies. Like we were saying, you want to get an idea of how far into the term you are, if that's if that's the policy that you have, get an idea of the cash value and the death benefit and what your options are. Recent Social Security statement, because each year you're paying in, the benefits changing a little bit. If it's applicable, a divorce decree. If you haven't read the decree in a while, it might be worthwhile to just take another look at that, especially if it had any wording about a portion of your pension payment getting paid to a former spouse. And then oftentimes people want to start to incorporate their spouse's benefits into an overall plan too. So this is just, I thought it'd be worthwhile to have a visual of some of the key things to look at when you're taking a look at the leave and earnings statement. So right at the top, the gross pay is an important one, but total deductions and net pay are also important relative to the fact that when you get to being a retiree, it's pretty much taxes, health insurance, dental, and vision. Retirement, the first retirement contributions go away, TSP contributions, depending on how much you're putting in. That's a big one, biweekly. Social Security tax is no longer applicable. You have federal tax, potentially state tax, depending on which state you retire in. No more city tax, FEGLI coverage. That if you take the 75% reduction option, that'd be a premium for a finite window of time. But knowing what you have, the pricing of what you have relative to what your options are in retirement is an important one. And then no more Medicare tax anymore. So oftentimes the net is closer than people think it is when you take into consideration all the stuff that you pay for while you're working full time that goes away when you're a retiree. And these ones, this is a snapshot of just like a normal retirement estimate. So at the bottom of the page, you're looking at a lot of the identifying information. So some of the key things to be aware of here, the date that you want to have the estimate run, keeping a look at the high three average that they use to calculate that pension payment. And a very important one is making sure that your retirement service computation date is correct, because sometimes there'll be a discrepancy between your leave service computation date and your retirement service computation date. Your retirement service computation date is the time that they're using to calculate your pension payment, whereas leave is kind of like a catch-all for every chunk of time that would be hypothetically creditable towards retirement. Oftentimes there'll be a projection for your sick leave balance. And it's important to remember that sick leave just adds extra months and days onto the formula that they use to calculate your pension, and then survivor benefits, whether or not the maximum or the partial. So at the top of the page or at the top of the first page, there'll always be the gross number for your pension payment, but you want to take into consideration the survivor benefit that they'll be deducting out on a monthly basis. And in these, they give you an idea of what the first supplemental payment is going to pay you as well. So, and then moving on to one of the following pages, page 4 of these breakdowns usually gives you an idea of what your options are with FEGLI. So the important one here is knowing the difference in price between the 75% reduction option and the no reduction option, which is the difference between $40 a month or $301 a month. So that's an important one to look at too. This is another example of a retirement estimate. It's just different than the HR estimate that we just took a look at. This would be a snapshot of a GRB estimate. So some of the important things to keep an eye on with the GRB estimate, similar story. And you want to get an idea of the gross FERS pension amount. You want to have an idea, make sure the high three average that they're using is pretty accurate. Confirm the survivor option, that either the survivor benefit that they're using to calculate whether or not it's 100%, which is maximum, or 50%, or 100%, which is maximum, or the partial, which is a quarter of your pension. Get an idea of the cost of the survivor benefit right here. In this scenario, there isn't an annuity supplement that's being projected because in this scenario, this person was retiring in their mid-60s. So that would be a Social Security payment then. But it's good to familiarize yourself with how the different estimates look and some of the key pieces of information to keep your eye on. Moving on to things you should be aware of with TSP. So this would be a snapshot of one of the important pages on the TSP statement. So when you're looking at the top here, if you have a Roth TSP balance, the difference between your non-taxable Roth balance and the total. So taxable Roth balance would represent the money that you've paid in to your Roth TSP. The total balance, so like in this scenario, the 62,000 and change represents your contributions into the Roth TSP. The 95,000 and change represents the total value of the Roth component. So you got to remember with the Roth, you pay taxes on the money that you use to fund it, and then the gain grows tax free, assuming you take the gain out after age 59 and a half. So that's where that taxation comes into play. But at the bottom of the page is an important one too, because it'll break down how the money in the plan is invested relative to future contributions, or how the money is going to be invested for each biweekly contribution you're putting in. A lot of times when people are nearing retirement, they want to be conservative with the balance that's in the plan, and then take a little bit more of the market risk on the contribution side of things. So keeping the balance in G, and then having your contributions be invested in C, for instance, or CS&I isn't a bad way to do it, because the balance is protected. But then if the market's going down, each bi-weekly paycheck, you're buying shares at a discount, or kind of like auto dollar cost averaging. So that's an important one to keep in mind as well. And then in the normal estimates, when you flip to the second page, oftentimes it'll give you a breakdown of what you would be looking at for an annual leave payment, which oftentimes ties into the timing of when people retire. So a lot of times people target 12/31 for a retirement date if they have a pretty healthy balance of annual leave, because most of the time the leave year ends the first week in January. So you retire 12/31, there isn't a delay oftentimes in your pension getting processed, but that leave chunk gets paid to you in a new tax year. So if it was like this year, for instance, 12/31, that leave payment or 15,000 and change would be taxable income in the 2027 tax year. So, but if you don't have a huge balance of leave going into retirement, then it kind of frees up some of the dates that you can use. So that's an important one to think about as well. So choosing your retirement date. Minimum retirement age, this one's fairly rare, because you have to have 30 years of service in by 56 or 57. So in a nutshell, you got to hire on pretty early to be in that boat. Years of service is an important one. You want to take into consideration all the years that could be hypothetically creditable. A lot of times, military time is an important one here, whether or not you can make a deposit for military time. If you have enough years in to be eligible for the first supplement, knowing what that's going to pay you relative to the Social Security payment, it's not uncommon for people to see anywhere from a $500 to $1,000 a month auto increase just by switching from the first supplemental payment to the Social Security payment. Because the first supplemental payment is just based off of your years of FERS service with the federal government, whereas Social Security is based off of your entire service history with Social Security. So jobs you had when you're in high school, for instance, as long as you were paying in, they index those for inflation. TSP withdrawal timing is an important one. If you're in that boat where you have a mandatory retirement, or you have years in to retire before 59 and a half on an unreduced pension, sometimes people will leave a chunk of money in TSP and use it for monthly income and roll the rest out. So a lot of strategy and planning goes into that, especially if you're retiring on an unreduced FERS pension prior to age 59 and a half. And then that leave balance payout is an important one. Oftentimes, if you have a healthy balance of leave, a lot of times people target the end of the year for retirement date to max out that leave payment. Because in theory, you can carry over generally 240 hours. And then assuming you don't use any hours the last year of employment, you could hypothetically sell back 448 hours of annual leave, which would be a pretty healthy payment. But you got to live too. So it's pretty rare to see that much leave. So moving on, just a refresher about minimum retirement age. For a long time, for pretty much everybody, it was 56, but this one's a byproduct of the year that you were born. So if you were born 1970 or later, 57 is the minimum retirement age for you. Just a refresher on some of the key timeframes for FERS retirement pension. So minimum retirement age, so that's 56 or 57 with 30 years of service, age 60 with at least 20 years of service, or age 62 with 5 more years. Then you fall into that 1% times high 3 times years of service pension calculation factor. If you wait until 62 and you have 20 or more years, that's when that calculation factor goes up by 10% to 1.1 times high 3 times years of service. This one really depends on how close people are to burnout status. If they're happy with what they're doing, oftentimes they'll work to 62. If they're teetering on the edge of burnout, then a lot of times 60 is the magic age for a lot of folks. So, and it's important to remember creditable service, or the service time that impacts leave versus your retirement service computation date. Like I was saying earlier, usually it's military time here. Oftentimes they'll package your military time into your leave service computation date, but you have to make a deposit for that time for it to be credited to your retirement service computation date. And if you're in that boat, I mean, it's pretty difficult. You have to have a lot of years, 20 years in to get military retired pay. So it's not uncommon for people to be in a boat where they can make a deposit for their military time. And 9 times out of 10, it's well worth the chunk of money that they'll charge you to get that credit, because it's going to bump up your pension payment by significantly more than they'll charge you to get credit for that. And then any unused sick leave, for a long time, they didn't used to give people credit for unused sick leave, but they called it the FERS flu over time, where people would get to the end of their careers and have a couple thousand hours of leave built up. So that was the main reason for giving credit for sick leave. Although, let's say you have a year of sick time, you can't use that in place of one of the years they use for the pension calculation. They just add it in addition to it. So, like, if you had a year of sick time and you were 60 with 19 years, then you wouldn't be able to use the sick time to get to 20. But if you were 60 with 20 years and you had a year's sick time, then they would use 21 years as the calculation factor for your pension. And then just a refresher on the difference. 10% doesn't sound like much, but 1.1, it makes a noticeable difference, especially when you're taking into consideration the cost of living increases going forward. But again, it's not uncommon for people to go out at 60 because they're getting close to burnout status. So a little refresher about that FERS retirement supplement. It's designed to bridge the gap between when you can retire on an unreduced pension and being eligible for Social Security. So the main bullet points here would be minimum retirement age with 30 years or 60 with 20, where you get 2 years. If you're 60 with 20, 2 years, essentially 2 years of supplemental payments, and then it'll stop because then you're eligible for Social Security at 62. But like I was saying earlier, the supplement's just based off of years of FERS service. So the more FERS service you have, the closer it's going to be to your age 62 Social Security payment. But one of the things that is a little frustrating, if you're in a boat where you made a deposit for military time, they don't credit that into the calculation for the supplement. So that's something to be aware of as well. Or just knowing the auto pay increase that you would hypothetically see between the supplemental payment and then whatever Social Security is going to pay you at 62. So, and it's important to know that the first supplement, when you're getting that payment, they don't let you go make like an unlimited amount of money. So knowing what counts against the earnings test is important, and knowing what it is. So for this year, $24,480 is what they'll let you make in terms of like W-2 salary income, and not have to worry about that supplemental payment going down. Or essentially an extra $2,040 a month is what you can make without having to worry about that payment going down. So earnings test is applicable if you're in that special group, so law enforcement officers and air traffic controllers. It's not applicable until you hit MRA or age 56 or 57. So like sometimes people have enough in that special category, they have enough years in to retire, like 50 with 20 years of service, for instance. If you're in that boat and you were working outside, you wouldn't have to worry about that earnings test until you got to MRA. And what counts against the earnings test? A lot of times people are confused about this. So non-work income does not count against the earnings test. That'd be like your first pension or government pension benefits, investment earnings, interest, any annuity payments, capital gains, or self-employed income. If you're getting paid as an independent contractor, like 1099 income, you can be a lot more creative with your tax planning. So in that scenario, it counts when you receive it, not necessarily when you earn it. So we've had scenarios where folks that set up LLCs, or they'll even set up 401k for the LLC to have avenues for squirreling away money and not having to worry about that supplemental payment getting reduced. But it's important to know the difference between non-work income and earned income. This is just a refresher Social Security statement. Big bold number on the front of the page is the benefit payable at full retirement age. So that'd be 66 or 67. But you got to flip to the second page to get an idea of what that age 62 benefit is going to be. Generally, we kind of take the approach of really how you win with Social Security is by squeezing as much money out of the plan as possible and living a long and happy and healthy retirement. So oftentimes that leads people down a road of starting the benefit sooner as opposed to later. But everybody's scenario is a little different. So if you're looking to figure out what full retirement age is, this one's a byproduct of the year that you were born. So if you're born in 1960 or later, it's 67. And then just taking a look at the payment amounts at different ages. So the big difference is that the earnings test goes away once you get to full retirement age. So in that scenario, 67. So if you turn it on between 62 and 67, there would be that earnings test applicable. But oftentimes people gravitate to the sooner benefit as opposed to the later. Because you got to remember that if you turned it on at 70, you just sidestepped 8 years of monthly payments to get to that higher number. So it feels like you're getting paid more, but really you're just getting a shorter duration of payments out of the pool of cash that they have set aside to pay you anyways. So oftentimes the scenario where it makes the most sense to defer it is if you can retire from the federal government and you get a consulting job making essentially the same as what you're making while you're working full time, but you can do it 2 or 3 days a week. That would be the main scenario for Social Security. TSP withdrawals relative to the age you are when you retire. So sometimes if people are in those early retirement scenarios, if you're a law enforcement officer, you can tap into TSP for monthly income and not worry about that 10% early withdrawal penalty at age 50. For regular retirees, it's age 55. So sometimes in these scenarios, people leave a specific chunk of money in TSP, use it for monthly income, so they don't have to worry about paying the early withdrawal penalty, and use that chunk to get them past age 59 and a half, and then grow the rest of the TSP money. They'll roll to outside IRAs and grow it a little bit more effectively than inside of thrift. So timing of age, years of service is all important relative to a TSP income strategy. Sometimes it's fairly rare, but sometimes we run into scenarios where if you're in a special group, you can retire at any age with 25 years of service. So I think the earliest that we've had special group retire was 47. Last year, we had a few people that could take the buyouts at age 53 or 54, for instance. So in those scenarios, they weren't eligible to take, if they needed money, like from TSP savings for current income at the point of retirement. 72T distribution is a way of calculating a withdrawal payment where you can use TSP money and not have to worry about the early withdrawal penalty. So just a little visual of how 72T works. Use a portion for current income, and then the rest of the money continues to grow and compound for a later date. And don't overlook investment management as well. So get an idea of what your withdrawal options are from TSP, which in a nutshell, that'd be like a lump sum payment or a partial payment directly to you, paid to checking, for instance. The payment directly to you would be a taxable event. Full or partial rollover to traditional Roth IRA. That's an option that a lot of people go with. Fixed monthly payments, specific dollar amount. That would be the scenario where you're a few years away from 59 and a half, and it made sense to leave a chunk in and use that for monthly income, getting paid directly from TSP. Or they also give you a life expectancy option or a fixed annuity option. Key things to keep in the back of your mind. So fixed monthly payments, obviously that's a fixed amount that you can change. The life expectancy payment, that one, there are probably better options for you, especially in the outside world. Lump sum or a single lump sum payment. Oftentimes when people are taking a lump sum payment, it's to pay off a chunk of debt at the point of retirement. But it's important to remember that depending on, the size of the withdrawal, it's going to be taxable. So you always want to take the taxable income into consideration when you're thinking about a large lump sum withdrawal. Annuity purchase, that would be like a fixed annuity directly from MetLife, but that one's kind of like the most plain Jane vanilla version of an annuity that you can get. So installment payments, custom amounts over time, or oftentimes people will pinpoint how much it makes sense to leave in TSP and how much it makes sense to roll to outside IRAs because of the fact that you can pinpoint there's just a lot more investment options to work with in the outside world. Different indexes, different sectors can certainly make a noticeable it can noticeably impact the growth potential going forward. So key consideration, market volatility, withdrawals, RMDs, which are now applicable at age 73. I've always said that life cycle funds are great, but if it goes to more of like a CD type of return potential, the closer you get to that target date, you also got to take into consideration, if you're retiring in 2026, for instance, you're presumably going to have hopefully 20 or 30 years of retirement ahead of you. So the idea is that you got to generate some growth out of that chunk going forward. And you can't afford for it to be like a G fund type of rate of return because G funds average annual since inception has been right around 4.5%, a little bit, maybe a little bit higher than that. But you also move past 4.5% for a required minimum distribution at a certain point in time as well. So always something to take into consideration. And oftentimes people will pinpoint a bucket that they want to use for short-term income, a bucket that's earmarked for like emergency opportunity withdrawals, and a bucket that's earmarked for long-term income. So tips to consider: having an adequate amount of emergency opportunity money is always important. Don't make emotional decisions. If you see your account value go down in a finite window of time, pulling it out of the market and parking it in G is certainly a way to lock in your loss. It's never fun to see the value go down, but if you don't keep it invested, there's no way for you to recoup those losses going forward. And then the people that pull it out emotionally oftentimes get paralyzed trying to figure out when to buy back in or move the money back into the market. So if you do that 4/5 of the way through the market recovery, you're going to be even more frustrated. And then rebalancing on a regular interval is important, and evaluating other income sources relative to the plan for TSP income. So you want to think about TSP withdrawals relative to the income that's rolling in from the first supplement or Social Security or your first pension. So this is just a snapshot of a strategy. Pink box would be like short-term current income. Green box would be liquid growth bucket or emergency opportunity funds. And then blue box would be long-term income or income after age 65 in that scenario. Address the legal and estate planning. That's always an important variable. Will or trust. Oftentimes people implement a trust, especially if they want to have control from the grave. I always say, let's say you have 2 or 3 kids, one of them you're worried might go buy a brand new car at a certain age if they get a chunk of money paid to them. Or they might buy something, squander the money. That's why people put trusts into place. Beneficiary designations, make sure they're updated and they're set the way that you want them to be set. So you don't have like a former spouse that's listed as a beneficiary for life insurance or investment accounts. Power of attorney, that usually comes into play when people are getting older. Healthcare directives, medical directives are always important. Now they're adding dementia directives and making sure your spouse knows what's coming down the pipeline with your survivor benefits and that they have that FEHB coverage for life. All right, so how do you start a retirement strategy? Our process is usually at least 2 or 3 steps. So first meeting is what we call a fact-finding meeting, where we send you a list of identifying information to gather. Second meeting, we take that information and put it together into a written plan for you, where it gives you options on what do you want to go, which options do you want to choose on pension. Here's what pricing is going to look like with faculty insurance as a retiree, an idea of income stream for first supplement, income stream for TSP savings. And then one of the important ones too is looking at that net monthly income comparison or gross income that's coming in from pension, TSP, the supplement or Social Security relative to the deductions that go away as a retiree. So looking at those nets can be an important tool for folks, especially to help them figure out how much money they would need to make outside or any income gaps that would that would need to be addressed. And then in subsequent meetings, it's reviewing the benefit options that you have, finalizing which choices you want to go with, and then implementing the plan and making adjustments as life happens going forward. So our relationship with clients doesn't stop at the point of retirement. Oftentimes plans need to be tweaked and adjusted as life happens. So it's an ongoing review process from there. So what items to bring for the first meeting? Recent leave and earnings statement, any estimates you can get your hands on, recent TSP statement, any other like 401k, IRA statements, life insurance information is always important, or long-term care, coverage amounts, duration, how much cash is in the whole life policy, for instance. There's just recent Social Security statement, and then divorce decree, or if you want to start to incorporate spouse's benefits into the plan, that's bring that identifying information as well. How about any questions, Patty?
We don't have any questions. And in
Well,
case you don't know, we have a podcast and YouTube channel. The Federal Retirement Podcast is on Spotify, Apple, and Amazon, and our YouTube channel is Benchmark Financial Group, Kansas City. Don't forget to like, comment, and subscribe. David, anything else?
Thanks for tuning in, everyone. If you think of any questions that you want to have addressed, feel free to give me a call, send me an email, or you can always submit those on our website as well. Thanks for tuning in, and hope to talk to you in the near future.